Yes. Well, you know, after the first week they come, see what they need to do, and then go, oh yeah, I can actually do that all on my own. And then by week 5, when it's review time for the exam, they go, I don't know what I'm doing. And everyone comes back in. Whatever. I get paid anyway. It's a problem when you've only got so many students that you've got 3 classes across the week, and we have to make it that way so you guys can all come along. All right, so last week we got through most of income, but there's a couple of things that I wanted to delay until this week, particularly in relation to dividends, because it's going to take just a little bit to get your head around what we do from a dividend perspective. But once you understand what we do and why we do it, it's actually quite easy to incorporate it into your tax calc. So I thought we'd start that fresh, so that it sinks in before you start thinking about your stats class. Was that exciting last week?
Oh, yes, very hot brain game.
I can tell you that actually stats and finance make more sense once you've been out in practice for a while, because you actually understand the commercial reality behind what you're doing rather than just learning the calcs. Kind of like tax, it does make more sense once you've actually had some practice doing it. Okay, so we did allowances last week, and I distinguished the difference between allowances and reimbursements. So remember, allowances we include in our assessable income. So whenever something is called an allowance, we include it in our assessable income. It does not necessarily mean that if you're paid an allowance for something, you will be allowed a deduction for it. We'll come to deductions today. But usually what will happen is if you're given an allowance for something and then you spend that allowance on what it's referring to, in most cases, you will be allowed a deduction for the expense that you actually make. The difference between the two will either be a positive or a negative, and that's what will be reflected in your tax return. So for example, if you get an allowance of $100 but you spend $150 on a deductible item, so let's take uniforms for example. If you get a uniform allowance, so an amount that's paid to you in order to purchase your uniform for work, and we'll talk about what constitutes deductible uniform expenses later on today, or maybe next week. But let's assume that the uniform you purchase is deductible. If you get an allowance of $100, yet you spend $150 on your uniform, the $100 is going to be assessable in your, or it's going to be included as assessable income in your taxable income calc, and then you'll be allowed a deduction for $150. So the net effect is actually a deductible item of $50. So that's generally how allowances work. Sometimes you'll be paid allowances for things that are not deductible for tax purposes. And in that case, the full amount of the allowance is assessable, but the item you spend it on is not. So entertainment is one of those particular examples. If you're involved in a sales kind of role where you entertain clients, you might be paid an allowance, and then if you spend $150 on lunch to entertain a client, that's not deductible under the deduction provisions. Again, we'll come back to that. So you'll have a net assessable amount of $100. That make sense? Reimbursements are different. So allowances, basically you don't have to justify how you spend that money. It's an amount that's paid to you irrespective of how you pay it or what you do with it. And that's the reason why we have the accessibility provision and then the allowable deduction provision. Reimbursements are very different because reimbursements you are generally given the exact amount that you spend. So it's almost like you're acting in an agent role for your employer. So you're purchasing something on behalf of your employer and they're just reimbursing you for it. And if you think about that logically, it's not your expense, it's your employer's expense. So therefore you shouldn't have tax consequences on that. So that's the general logic behind a reimbursement. So as soon as you see the term reimbursement, we don't include it as an allowable deduction, and on the flip side, we don't include it as assessable income, and on the flip side, we don't include it as an allowable deduction. It's a zero net effect to the employee. The one exception is where you receive a reimbursement on a cents per kilometre basis. So you use your own motor vehicle to travel to clients, and your employer agrees that they will pay you a certain amount to reimburse you for the use of that car. And it's usually on a cents per kilometre basis. So you travel 10 kilometres, you get paid 70 cents per kilometre, $7 is what will be paid to you. Now that is not, while it's called reimbursement in the Tax Act, and it's under section 1570, which is in the 1997 Act, they call it a reimbursement, but it's not truly reflective of a reimbursement. And the reason being is because if they pay you an amount based on the number of kilometres you do, it cannot be a true reimbursement for an expense because you don't know how much it costs you to run your car because it includes depreciation and maintenance and fuel and all sorts of things. So it cannot be considered to be a true reimbursement, so in that case it is an allowance. So the amount they pay you is an allowance you include in your assessable income, and then you will be entitled to claim a deduction for your motor vehicle costs under one of the methodologies that are allowed in the Tax Act. Those two methodologies now are a logbook methodology based on your actual expenditure, so all of your expenses in terms of your motor vehicle, or an arbitrary cents per kilometre methodology that the ATO give you. So they'll say your engine size is this, we are going to allow you to claim a deduction of so many cents per kilometre. All right, so that will be an in and out like an allowance. Call it a reimbursement, but it is truly an allowance. Everything else that's referred to as an allowance, you include it in your assessable income, consider the deductibility provisions. Anything else that's referred to as a reimbursement, don't include in your tax return at all. Okay? All right, so let's have a look at the dividend provisions. Now, you all know what dividends are. Basically the distribution of profits from companies. So if we go back to the charging provisions we talked about last week, we said there's two kinds of taxpayers in our system. Only two entities that pay tax. One is an individual and the second is a company. Generally what will happen from a tax perspective is the ultimate recipient of the income is the one responsible for paying the tax. But in recognition that in terms of a company, in recognition of a company being a separate legal entity, the legislation recognises the fact that a company can choose to reinvest its own profits in itself, so to hold on to those profits and not distribute them to their shareholders. And it might be that a company makes a profit now and reinvests it in terms of expanding the company and doesn't pay a dividend out for 5 to 10 years. It can be a delay, particularly with startup companies. The ATO or the government don't want to wait 10 years before they get their tax when the individual shareholders are the ones that receive it. They want to make sure they're collecting the tax on the profits as the company makes them. So that's the reason why a company is a separate tax-paying entity. We'll come back to trusts and partnerships later on in the unit. So in recognition of they don't want to wait for the tax on those profits, they will tax the company at the time they make the profit. But in recognition that the company will then pay a dividend out to the shareholder out of their post-tax dollars. So I'll come back to some accounting concepts. Remember that a company is not able to pay a dividend unless it's got retained earnings sitting in its balance sheet, yeah? If it's got a negative equity amount, then it's not allowed to pay out a dividend. So that's based on accounting standards. Those retained earnings that sit in the equity section of your balance sheet are reflective of post-tax profits. So what the profit is, less the tax the company's paid on it. So they then pay that dividend to the shareholder. Now if they pay that dividend to the shareholder and that net after-tax profit is then subject to tax in the hands of the shareholder at their own marginal tax rate, we potentially have double taxation. So we have tax paid by the company and then an additional amount paid by the shareholder. And when you add up those amounts of tax, you generally end up with a tax rate in excess of 50%. So to prevent that, we have what we refer to as a gross up and credit system. And what that allows us to do is effectively attach the tax paid on those profits, so it kind of floats with the profit itself. All of that gets passed out to the shareholder. So the post-tax profits plus whatever tax they've paid on those profits along the way goes out to the shareholder, and the shareholder then includes that entire amount, both amounts added together, in their own tax return when they receive the dividend. Then what happens, so that's what we refer to as the gross up component. It's the effectively the shareholder is treated as if they're receiving the pre-tax profit in their own right. Then we have the credit system, which is then allowing a credit in the tax calc at the bottom as a credit against the tax that's payable on that. So if we work through it and say that a company earned $100 worth of profits, let's assume a 30% tax rate for companies. Let's ignore SPV for now. $100 worth of profits earned by the company would attract tax of $30. Happy with that? Which leaves them $70 in their retained earnings, which they can pay out to their shareholder as a dividend. When they pay that dividend out to their shareholder, $70 goes out by way of cash. But that $30 worth of tax they paid floats with that $70 attached to it. So the shareholder is treated as if they've received $100, being the pre-tax profits of the company. That $100 gets included in their assessable income. You then go through the calculation. Let's assume no other income, no other deductions along the way. That $100 goes in their tax return. If that's all they've earned, they're under the tax-free threshold, so there's no tax payable on that dividend for that shareholder. What would then happen is that in the tax calc, gross tax payable is zero, Medicare levy is zero, no tax payable. But then they would then be able to have a line item in there which includes the franking credit that floats with that income, the 30%, so the $30. They will put it in their tax calc, and that $30 then comes back to them by way of refund. Okay? So the company originally paid the $30 in tax, but the shareholder shouldn't have paid any tax on that profit had they received it in their own right. So the gross up and credit system achieves that outcome. Does that make sense? Okay, so that's the general principle behind it. You'll never see a taxpayer in terms of our calculations where the dividend is the only thing they receive. We usually join it with other things. But in practice, you'll often see shareholders, but they don't do anything else, all they do is invest. And so the dividends are the only things that they receive. One thing I will note about that is a shareholder can be any kind of entity. So it can be an individual. At the moment, we're dealing with individuals. Franking credits can be refunded to individuals. They can get cash back. If the shareholder is a company, which it can be because we can often have chains of companies, so we might have a parent entity and then a subsidiary. The subsidiary passes up its profit to its parent entity who then pays it out to its individual shareholders. If the recipient of the dividend is a company, they are not entitled to a refund of those franking credits, so they don't get the cash back. But what does happen, they don't lose the benefit of them. What they do is they actually convert to the pre-tax equivalent of a deduction. So what we do is we convert franking credits into losses, basically, which can then be claimed as a deduction. So we have to gross it back up to its pre-tax deduction. So $30 worth of franking credits would then be recognised as a $100 deduction, reducing their tax effectively by the same amount. Okay, we'll come back to that when we do companies. At the moment, we're dealing with individuals, so that refund is available. So let's have a look at the mechanisms in the Tax Act to make that work. So dividends, we talked about last week the difference between ordinary income and statutory income. Dividends would usually fall under the definition of ordinary income because most people you would speak to would consider a dividend to be income. However, there is a particular section within the 1936 Act, so this is the old Act, which is section 44, which specifically includes dividends in your assessable income. Okay, so dividends are ordinary income and statutory income in most cases. The tiebreaker clause in the Tax Act basically says statutory income takes precedence. So if there is a specific section in the Tax Act which includes an item as assessable or deductible, that takes precedence over the general provisions. So we would include dividends in our income as assessable under section 44, not section 65, although both are probably equally applicable. Make sense? So if we're asking you to cite section references and you're including a dividend in your income, you'd be using section 44 as being the reason you're including it. That includes dividends both locally and foreign, but for our purposes we'll be including locally sourced dividends, so Australian-based profits. The other section we deal with is in the 1997 Act, and it's in section 207, which incorporates the gross up for our franking credit. So for any dividend that is what we refer to as a franked dividend, there will be two line items that you will always include in your assessable income section of your account. So the physical amount of the cash dividend is your first line item under section 44. The second amount is the associated tax, which we call the franking credit. It'd be a separate line item. So if we go back to that example I was talking about of a $100 pre-tax profit, that would represent two amounts. The $70 that's paid out by way of cash, representing the after-tax profit from the company, under section 44. Section 207.20 subsection 1 is the section in the Act which then provides for that gross up amount, so to incorporate that associated franking credit into our assessable income of the $30. Yeah? Okay, so if I'm talking about franked dividends being dividends from profits that have been subject to tax, if I told you that there's a possibility of getting an unfranked dividend, what would that mean?
Hasn't been paid on those profits.
Yep, so the company has not paid tax on those profits. Why would a company not pay tax on profits, do you think? You're not expected to know this, we haven't gone through it, it's just something that you might want to think about, reasons why a company might not pay tax. Most of the reasons why a company will not pay tax will be because we have different calculations for accounting income versus taxable income. So we treat things differently in some cases for tax and accounts. So it might very well be that we're in a situation where a company has a significant amount of tax deductions which are not considered to be accounting deductions. We will go through where those differences arise when we deal with reconciliation before we move on to the entities, so you'll be able to see that. If you've done any accounting units previously, which has talked about tax effect accounting, if you've looked at a set of financial statements which has a deferred tax asset or a deferred tax liability in their financial statements, and there's a difference arising between your taxable income and your accounting income, that's the reason why we have them. So we might have situations where a company doesn't pay tax but has accounting profits, meaning it can pay out a dividend but it hasn't paid tax on those profits. In those cases, we refer to them as unfranked dividends. If you receive an unfranked dividend for tax purposes, it means there's no associated tax paid with it, and then we don't need to worry about the gross up and credit system because there's no tax previously been paid. So franked dividends, something for you to remember in terms of your structure. Franked dividends will always have two line items in your assessable income. Cash amount of the dividend, add the franking credit. It will then have an associated franking credit claimed in the tax calc at the bottom. So three things you need to consider. If you have an unfranked dividend, one item we include, and that's simply the line item dealing with the dividend in your assessable income. The difference between the two. You can have a dividend that's a mixture of franked and unfranked. So if you imagine that a company separates its profits into two separate buckets, two separate pools. A pool of profits that have been subject to tax and a pool of profits that have been not subject to tax. You might pay out a dividend of $200. $100 coming from the pool of untaxed profits, $100 coming from the pool of tax profits. In that case, you will have an unfranked dividend of $100 and you will have a franked dividend with the cash amount being $70 and the associated franking credits of $30. Yeah? For our purposes now, we don't have to calculate that. You will be told in your questions if the dividend is franked and what the associated franking credits are. So that's all you need to know. How much is the dividend that's paid? So in your question it will say, dividend paid $70. Associated franking credits 30, and you would be expected to show it like this. Or it will say an unfranked dividend of $100, and you would just include the $100 as your line item. When we deal with companies, we'll come back to how those are calculated. We'll see the mechanism of that calculation and how it's tracked, but for now we don't need to worry about it. Okay, so if a question happens to say a dividend was paid and it was franked to 50%, don't do anything funky with your calculations. Don't try and divide things by 50 or multiply them by 50 or divide them by your shoe size or whatever calculations you want to do. There is no complicated calculations. Trust the information you're being given. If it's franked, make sure you include the two line items, the dividend and the franking credit. If it's unfranked, just the cash dividend is included. Simple as that. All right. So on the 1st of July, Exco declares a dividend of $700 in favour of Mrs. Smith, who is a shareholder of the company. In its statement to Mrs. Smith, it informs her that there are franking credits attached to the distribution of $300. So your question says, cash dividend of $700 or a dividend paid of $700 and the franking credits attached to $300. How would you put that in your assessable income? How many line items have we got? Two. One being the amount of the cash dividend, which is? Yep. And one being the amount of the franking credit, which is $300. So the total amount we're including is $1,000, and that is representative of what the profits were for the company before they paid tax. Treating that shareholder as if they received those profits in their own right. Yeah? I'm not going to stop these presentations to go through it because I spend a lot of time working through the examples theoretically anyway. If there's something I'm saying that is not making sense, stop me and we will work through it step by step, okay? So in this particular example, we've got $700 of the dividend being included. Now this doesn't include a section reference next to it, but if I asked you to put the section reference, that $700 would be included under what section? 44. Yep, so section 44 of the 1936 Act is the reason we're including it. Just trying to get you into the habit of recognising the sections of the Act. You are not generally going to need to include reasons, those section references in your exam. But if you get familiar with it, you know where to find it, and should it pop up, you can deal with it. We include the $300 line item for the associated franking credits, and we're including it under section 207.20 subsection 1. So these are where you're just going to tag the sections of your legislation. So our total assessable dividend is $1,000. That will be added to all our other assessable income. We will then subtract our allowable deductions to get to our taxable income. We then work through our tax calc, and we get to our final position after taking into account our franking credits as an offset. So if Mrs. Smith had other income of $49,000, salary and wages, doesn't matter what it is, let's assume it's under 6.5. We're going to add to that the cash dividend of $700. This drives me nuts. Where it doesn't line up, drives me nuts. Okay. So we're going to add our cash dividend of $700. We're going to add to that our franking credits of $300, giving rise to a total taxable income for this taxpayer of $50,000. Assume that there are no further allowable deductions, so our total taxable income is $50,000. We end up with tax payable of $7,797. What tax rate are they falling into?
32.5.
Yep, so we're in the 32.5% tax bracket. So we would work that out by taking the $50,000 assessable income, subtract the lower part of that threshold, which is $37,000. We'll end up with $13,000 excess, which is then taxed at 32.5%. And we will add 3,572 to that amount, which is the tax on the previous two bands, 0 for the first band and 19% for the second band. We end up with $7,797. Remember, everything in this part of the calculation is shown in dollars and cents. Everything in the previous part of the calculation is rounded to whole dollars. Most of the figures you'll be provided will be in whole dollars, but you'll get dollars and cents where you might have to do some apportionment calculations like prepayments and those sorts of things. So all in whole dollars. Tax calculation is always calculated using your taxable income figure in whole dollars. So please remember that if you're putting a long line of things in your calculator and you get to a taxable income at the end with dollars and cents, cancel it out and actually put in a figure in whole dollars, because otherwise your tax calc will be wrong. And if I'm marking it, I will mark it incorrect. Okay, your tax calc always has to be on a whole dollar amount. We haven't dealt with Medicare levy yet, so we won't include it. But assuming no other offsets or anything like that, we'll come back to a low income tax offset in a minute. Ignoring all of that for now, we are going to subtract from that $300 and see, this is I'm only allowed to do my own slides. I would show it like that so that I remember when I'm doing my calculation it's a subtract item. It's really easy to get it wrong if you don't show it visually. So take off the $300, meaning that this particular taxpayer is going to pay a total of $7,497. But in respect to that dividend, let's assume that the dividend floats on the top of our taxable income. So in this case, it's the top tier. This person receiving a dividend of $700 cash and $300 worth of associated franking credits, so pre-tax profits of $1,000, that's floating in the 32.5% tax bracket. The company paid tax of 30%, so effectively what's happening here is the taxpayer is paying the additional 2.5% worth of tax that the company hasn't already paid. It's the idea behind it. Okay, it's not always easy to reconcile that, but if you understand that concept, it makes sense why we do what we do. Yeah? So Section 67 of the 1997 Act is the section which allows individuals to be able to get a credit for the franking credit, to get a refund of the franking credits if their franking credits exceed their total tax payable. Do you remember when I said to you last week that there's a difference between offsets, concessions provided by the government, and credits, so where tax is being paid elsewhere? You can't get a refund of the concessions, but you can get a refund of the tax paid elsewhere. A franking credit is an example of tax paid elsewhere. It might not have been paid by the physical taxpayer receiving the dividend, but someone else has paid it on their behalf, and this being the company. So they're entitled to a refund of it. When you're setting out your your answers to questions, you always, and you're listing your offsets and credits that could be available, because you might have several, you always list your concessions first. So they always go in that order because you want to make maximum utilisation of any concessions that you can get so you can receive the maximum amount of cash back. If you do it in the other order, what you might find is you have a situation where your credit, your tax credit, so in this case a franking credit, basically absorbs all of your tax payable, and then you can't take advantage of all of that concession that you would be allowed because it only reduces it to zero.
So offsets, then credits, is that
right? Yeah. So offsets, concessions, so we'll only talk about the low income tax offset in this course,
right?
And then credits. So low income tax offset, PAYG withholding, PAYG instalments, franking credits, because they're all representative of amounts that could be refundable.
So they are offset against the tax liability?
Yes. Yeah.
So there may be some that can come as around the deductions.
If you're a company for the franking credits, yeah. But for now, we don't need to worry about that. We'll come back to it when we deal with companies. So we'll do the tax count first. We'll go, okay, our taxable income is that. Franking credit doesn't appear as a deduction, it actually appears below the line. So gross tax payable, which is your rates times your taxable income. We will then add to that Medicare levy if it's appropriate, and in most cases it is 20%. That will give us a total payable figure, and from that we will subtract our low income tax offset if it's available, and then any credits, franking credits, PAYG from that, to give us a final tax payable or refundable. Just make sure that you're indicating whether it is a payable or refundable. If you're using brackets like I show you, you'll show it as a negative and it'll indicate it's a refundable. Yeah. All right. We will go through, I'm going to go through some questions that will incorporate some dividends into some wider answers. So I think that's actually probably more productive today than it is going through these examples as they sit alone, because you'll never see them sitting on their own. Here's an example of a wider scenario where we include different things. So we've got salary of $26,000, we've got a dividend of $10,000, and an associated franking credit of $4,286. Total taxable income is $40,286. The tax payable on that, we're sitting in the 32.5% bracket, so 40,286 less 37,000 multiplied by 32.5% at the 3,572. That's what gives us the 4,639.95. We are going to subtract the low income tax offset. We will come back to that because we still need to go through how that's calculated. But that's a concession, so we will apply that first. That's why we do it in that order. I will put it in brackets. There are some personal tax offsets of $3,700 that's provided in that example of $3,700. Again, it's a concession, so we would apply it first to bring our tax down to $544.24. After we've done that, that's when we apply our credits. So if we have PAYG withholding on the salary, we would include it here as well. We're not told about that, but we do know there's a franking credit of $4,286, which will give us a tax refundable of $3,741.76. If we did it the other way around, so if we applied this up here, we wouldn't be able to utilise all of these offsets because it would soak up most of our tax payable without giving us a refund. I tell you that from a theoretical perspective and how we're setting out these. If you're in practice and you're doing, if you go out into practice, you never do tax returns by hand, unless you're in a dinosaur kind of accounting practice. But I don't even think the ATO will accept handwritten tax returns anymore. Everything's electronic. So you have software that basically calculates the tax for you. You populate it with all of your income and deduction items, send it into the ATO, and they do an automatic calculation of your tax payable. Your software will also do an automatic calculation of the estimate. They always order it in the correct way. So they always apply the offsets first before the credits. So when you think about it, when you do it electronically, if you do it on your own via the e-tax system, or you do it via an agent, it automatically calculates it in the right order. But you need to, because you're demonstrating the theory behind it, you need to show it in that correct order. Okay. So that should now pad out your understanding of our income items. We are just going to quickly run through some items that we specifically exclude from our assessable income because they are considered to be exempt income. So we have a whole bunch of different things that we receive, so different amounts that we receive. Most of them are considered to be taxable income in some way, shape or form if they're not caught under the ordinary tax provisions under section 6.5. Then there is a separate section in the Act that will usually capture them, like dividends. There are certain amounts that aren't dealt with under either the ordinary provisions or the statutory provisions, and we exclude those. They are what we refer to as non-assessable, non-exempt income. And we talked a bit about them last week. So windfall gains, like lottery wins and prizes and those sorts of things, pocket money, domestic amounts paid, are not incorporated into your income tax because they don't fall under one of those definitions. Then there is income that would be either considered to be ordinary income under section 6.5 or statutory income under a particular section and is then taken out of your income. Do you remember how last week I talked about some how I use very visual examples? So sometimes you put things in the bucket, start with empty buckets, put them in. Sometimes you start with full buckets and take things out, and sometimes it's a combination of the two, you put them in and then sometimes you take them out. Exempt income is one of those things that it's kind of, you put it into the bucket because it falls in with one of those definitions, and then you take it out because there's a particular reason in the Act that you take it out. And that defines our exempt income. So exempt income is provided for under a number of provisions within the Tax Act. We only deal with very limited 2 items of income that's exempt for individuals. But the categories of exempt income, certain entities are exempt from income. Can anyone give me an example of an entity that's exempt from income tax? Charities. Yep, that example you'll come across all the time. So they call them public benevolent institutions, but charities are what a common term for them. So they are exempt from income tax if the ATO has ticked them off as being exempt. You can't just choose to be, you actually have to go through a number of hoops to become exempt from income tax. We'll talk about some more examples. There are certain kinds, so that an entity that's exempt from tax, all of their income is exempt from tax. Yeah, because it's the entity that gets the exemption. There are certain kinds of income that is exempt from tax. So it doesn't matter which kind of entity receives this income, the Act provides that that particular kind of income is exempt. So the exemption attaches to the income itself rather than the entity. And then you can get another category, which means that income which is generally not considered exempt will be exempt if there's a certain kind of taxpayer receiving it. So there's 2 conditions that need to be met. The income needs to be a certain type and the entity receiving it needs to be a certain type. So top 2 are blanket provisions. Entity is exempt, everything's exempt. Income is exempt, then it's exempt no matter who receives it. The third type is the 2 conditions. Income is exempt as long as it's earned by this kind of entity. So public benevolent institutions, we've talked about charities being one of those examples of an entity that's exempt from tax. Religious bodies are exempt from income tax, and you would have heard things like that pop up in the news probably in the last 2 years where people have said no, religious institutions shouldn't be exempt from tax because they accumulate significant amounts of assets. Scientific or research institutions, as long as they're listed, are generally exempt from tax. So we talk about charities, but medical firms that do, or institutions or entities that research particular diseases and those sorts of things fall within that category of being exempt. And generally schools and universities are exempt from income tax as well. So they're the 4 different kinds of categories. Then there are some specifically listed entities that are exempt from tax. For our purposes, individuals aren't exempt from tax ever in their own right. So usually it's an entity of some other kind. So we don't have to worry about that kind of exemption. What we do have to worry about is the income which is exempt when it's received by the entity we're talking about, so individuals. Let's get through those. So ordinary or statutory income that is exempt for individuals, that's what we're talking about now. The 2 categories that we are going to deal with, actually 3 categories we'll deal with. The first being any payment that is made to someone as a result of being a member of the Defence Force Reserves. Please remember that it is only the reserves that get an exemption for the payments made. If you are a member of the regular Defence Forces, Navy, Army, Air Force, and you get paid as a result of those services, that's ordinary salary and wages and is subject to tax. Only when you're a member of the Defence Force Reserves, so you all know what the reserves do, kind of sit there in the background, they do some training and they get called upon in the event that they are needed. In peacetime, generally not. They just keep up their training. Sometimes they're used to keep the peace in neighbouring countries. We did have a lot of reservists a number of years ago, 10 years ago or something, head off to Papua New Guinea to try and stifle the coup over there and keep law and order. So we use the reserves for that kind of thing. But it's to encourage people to be a member of it. I mean, people are working full time, generally they won't want to go and do something else unless there's some benefit to them. And by getting tax-free pay for it, kind of encourages people to put their name down, join up. The other two that we will deal with is education payments. For example, scholarships and bursaries received from certain educational institutions are tax-free or are exempt. So we don't need to include them in our assessable income. And certain welfare payments. For our purposes, we will deal with spousal maintenance, or you might see the word alimony, which is a very US term for it. But when a relationship breaks down and you've got a generally non-working spouse, you go through the family courts. Often the family courts will provide some sort of maintenance payment from the working spouse to the non-working spouse to allow for their living expenses. Those payments are exempt from income tax. Right, so they're the only three that we deal with. If you see any kind of other government payments, old age pension, New Start allowance, Austudy, what is it called now, youth allowance, it's not Austudy until you get past a particular age. All of those kinds of payments are assessable income because they're designed to replace what would ordinarily be assessable income by way of salary and wages. Yeah? So unless they're one of these particular kind of payments, then they will be incorporated into your income tax return. Lastly, in terms of things that we do not include in our assessable income, non-cash benefits provided to us as part of our employment relationship, and we refer to them as fringe benefits. So does everyone know what a fringe benefit is? What's the most common kind of fringe benefit that would be provided?
Vehicle.
Yeah, the use of a motor vehicle. So if basically you receive a benefit from your employer in a non-cash form, if you receive anything that would ordinarily cost you money to actually do yourself, so you would have to pay for it out of after-tax dollars. So if you have the use of a motor vehicle between work and home, which is private in nature, then that's a benefit to you because you don't have to pay train fare or the cost of your own vehicle out of your own after-tax dollars. So it represents a benefit provided to you by your employer. That's one example of. There are other very common ones, particularly if you work in the city. Car parking is one of them, where your employer might very well pay for your car parking bay located under Central Park, where if anyone's ever parked there, you have to give up your first and half of your second-born child. Expensive to park in the city. So if they paid for your parking in the city, that is considered to be a benefit, because if you drove your own vehicle in, you'd have to pay for it out of your after-tax dollars. So if you think about it like that, would I have to pay for it myself out of my own money? If your answer to that is yes, then it's a benefit provided to you by your employer. Australia's quite unique in the fact that we have a separate system of tax that deals with those benefits under the fringe benefits tax regime. A lot of other countries actually treat them as payments in kind and will assign a value to them and include them as part of your taxable income. We have a separate regime, fringe benefits tax, which the fringe benefits on, or the tax payable on those benefits is payable by the employer rather than the employees. And as a result of that, because the tax on those is paid by the employer, the employee does not need to include the value of those benefits in their tax return. And the section that prevents them from including it is section 23 little l, which is in the old 1936 Act. As soon as we've got a letter in there, generally refers to the old Act. So 23L tells us that we don't need to include a fringe benefit in our tax return because it's considered to be a non-assessable, non-exempt amount. Not an exempt amount, but a non-assessable, non-exempt amount, so we don't include it. The employer will get the deduction or will get a deduction for the cost of that benefit. Going through the fringe benefits tax regime is beyond the scope of this course. It's quite complex. Anyone who is doing a Masters of Tax, you'll go through it in one of your other units, generally with your GST component, because it is a separate regime to kind of get your head around. The two different categories of income that's not included in our assessable income, so non-exempt, non-assessable, non-exempt income and exempt income, there's two different categories because they have an effect on some things differently. So, for example, exempt income will be taken into account when we calculate losses that have been carried forward from previous years or current years. And what it does is it effectively soaks up those losses, so you've got less things that you can carry forward to be able to deduct in the future. It's an odd scenario because what happens is if you've got losses, effectively exempt income in a way becomes assessable. Because what it does is it prevents you from claiming a deduction of losses in the past. So we'll come back to that at the end of the deductions provisions when we look at claiming losses. Like I said, it's an odd outcome in terms of the way the Tax Act works. Exempt income is also used in various other calculations for tax purposes beyond the scope of this course, but they are included in calculations when we work out whether that we have to pay some surcharges. So there's a Medicare levy surcharge if you don't have suitable private health insurance. You are not able, because under the fringe benefits tax regime, you can actually enter into what we call salary sacrifice arrangements. So you can tell your employer, take $20,000 of my assessable income and purchase a car and provide me that benefit. I don't want it in cash because I don't want to pay tax on it. A lot of people were taking advantage of that and reducing potentially their child support payments and those sorts of things along the way by reducing their total taxable income but still getting the benefit of it. So the rules were changed to prevent that from happening. So what happens is exempt income and those other sorts of things like fringe benefits are taken into account when working out these surcharges because it prevents you from entering into things that are not a commercial reality to reduce other obligations that you might have. Okay, so exempt income can reduce your losses that you can claim in the future, but non-assessable, non-exempt income doesn't. Okay, so it just disappears. It's like it never existed in the first place. So that will become evident when we work through the deductions provisions in relation to prior year losses and current year losses. So you need to understand the concept of exempt. All right, and the last two little bits that we need to go through are the low income tax offset and the low and medium income tax offset. So have you all heard of the low income tax offset? Yeah, if any of you are working part-time, you would see it appear on your notice of assessment from the ATO when you lodge a tax return. The low income tax offset is a concession provided by the government to actually compensate people for being on a lower amount of income than other taxpayers. Basically, anyone earning under, I'm only going to say this once because I have to say it lots of times fast. Next up, $66,667. If you earn under that amount, you get some part of the low income tax offset. The low income tax offset kicks in low income tax offset works so you have a set figure, which is $445. that $445 can reduce your tax payable. Can't get a refund of it, but it will reduce your tax payable down to nil, at least. But again, so if you had taxable income of $300 and you were entitled to the full low income tax offset, you would be able to use $300 of it to bring your tax payable down to nil, but the rest wouldn't then come back by way of a refund. That's what I mean when I say that. So $445 for anyone earning under $37,000 a year. That $445 reduces on a sliding scale, so a direct linear reduction of that $445 for every dollar of taxable income you go above $37,000 until you reach the cutout threshold. So the way it works is 1.5 cents of that offset disappears for every dollar of income that you earn over $37,000. Okay? So in the back of your PAT, in the tax rates and tables, there is, down the bottom of that first page, is the low income tax offset table. So it tells you if you earn 0 to 30, we use it the same way as we use the thresholds for tax. If you fall in the $0 to $37,000 band for taxable income, your tax offset is $445. If you fall in the band between $37,000 and $66,667, we have a calculation we must apply, and that's what gets our linear reduction in that amount. So basically for every dollar, and just be careful that you get this, you understand how the calculation works and you get it right, because I see it done in the reverse often enough. So basically you start with your offset of $445, which is your max. Then you reduce it by that second part of the calculation for 1.5 cents for every dollar you go above that. And we do that by looking at what our total taxable income is, subtracting $37,000 from it to give us how much we exceed that threshold. We multiply it by the 1.5 cents, or represented as 0.015. Don't miss out that first zero in your decimals. Don't make it 15 cents for every dollar. I see that a little bit as well. And that second part of the calculation gives us the reduction, not the amount of our offset, but the amount our offset is reduced by. So that's why we always start with the 445 and we subtract that second part of the calculation. So like I said, I'll often see the calculations done where they forget to put the 445 at the front and subtract it from it. All right, does that make sense? Okay, so it is calculated under Section 159N of the 1936 Act. So it's been in existence for a significant period of time, ever since I can remember, ever since I've been doing tax returns and ever since I've been in practice. We've had some sort of low income tax offset. The way we've calculated it has changed over the years, and it is in a current state of change. So we've had recent legislation which will basically move our low income tax offset to a different amount by 2022. But at the moment, we've actually got two offsets that we need to calculate. So I will actually have a look at the example for the low income tax offset in your PAT, because it is worthwhile just working through the calculation. So go to your PAT. On page 61, there is example 1.10, which is calculation of a low income tax offset. So we're told Jeff has taxable income of $30,000. Calculate his net tax payable. So generally, for every question you get, you're going to have to calculate the full net tax payable, including all of the components. So on a taxable income of $30,000, the tax payable sits in the band at 19%. It'll be $30,000 less $18,200 multiplied by 19%. So that will give you tax payable, gross tax payable of $2,242. Happy with that calculation? Yep. To that, we're going to add Medicare levy. Now, we'll talk about Medicare levy. It's not actually in the slides, but Medicare levy is imposed on every individual in Australia as long as they derive a certain level of income. So Medicare levy is 2% of your taxable income. Yeah? Only applicable to individuals, so it won't be applicable to any other entity that we're dealing with. It's only individuals because companies don't go to hospital. Some need to, but not the kind of hospital we're talking about. So, general deal with Medicare levy is it's 2%. In your tax rates and tables, on the second page, on the top is a table where Medicare levy kicks in. So if you've got, so these are the rates for the 2017-2018 year, because when we write this book, the new rates aren't out, so we use a year's old rates. So anyone earning under $21,980 in any tax year is exempt from the Medicare levy. They don't pay it, 0%. In the gap between $21,980 and $27,475, the bit that exceeds $21,980, so the amount your taxable income exceeds that, your Medicare levy then is 10% of that excess. Yeah? And that works out, so that gap that's there works out so that 10% of that total gap, once you get to that top rate, the 27,475, it's then the amount that you get from that calculation then represents 2% of your total income. So it's a way to slide that scale up. Once you're above $27,476 worth of income, you have a flat rate of Medicare levy at 2%. Yeah? Often it's worthwhile to have
Progressive or fixed?
flat. Yeah, Medicare levy is a flat rate, so there's no progression to it. Everyone's 2%. The only time there's a sliding scale or progressive is where you sit between that middle band there. Sometimes it's worthwhile sort of going back and proving that those gaps give you that result, that sliding scale from 0 to 2%. Let's have a play with the numbers and have a look at how it works. It kind of cements your understanding of how those rates work rather than using them blindly. Get some time. Case? Yep.
Can we use decimals for this one? The lead dollar.
Medicare levy is always expressed in decimal places, yeah, dollars and cents.
What about NIP?
Yes, yeah, because it all sits below that line. As soon as you get under taxable income, every figure under that is in dollars and cents. So make sure you round it to 2 decimal places. So because Jeff is over that threshold of $27,765, he will pay the full Medicare levy, which is 2% of his taxable income. $30,000, 2% gives him $600 with that. We're not told about any other things he's entitled to, but so you add those two together, gross tax payable plus the Medicare levy, that's how much he has to pay. But he is also under the top layer of that band, so he's entitled to the low income tax offset. At $30,000, he's below the lowest threshold of $37,000, meaning that he can get the full advantage of the tax-free threshold, which is $445. So if you look at that table for the low income tax threshold, if you're below $37,000, it's the full amount. If you're above $66,667, it's nothing. It's only that bit in the middle that you'll have to do the calculation. We like giving you examples where you have to do the calculation. So his total net tax payable after taking off the low income tax offset that he's entitled to is $2,397. Happy with that? So rework your answer if Jack's taxable income is $40,940 and $78,000. So tax payable on $40,940, we go over that bottom threshold, so we're in the 32.5% tax bracket. 940 less 37,000 at 32.5 at 3,572 should give you a 485,250. Add to that the Medicare 2% on that taxable income. Medicare levy is 818.80. So the tax payable is 561.30. We are then going to subtract from that the low income tax offset because his income in that year is below that top threshold of $66,667. But it's above $37,000, so we've got that slide in threshold we need to work through. So for every dollar he exceeds $37,000, his low income tax offset of $4.45 is going to reduce by 1.5 cents. And that's what that calculation does. So $49.40 less the $37,000 gives us our excess. We multiply that by 0.015, which is the 1.5 cents, to tell us how much it's reducing by. We then subtract that from $445. So we've got $445 less $59.10, meaning his total low income tax offset is $385.90. Yeah? If you ever end up with a low income tax offset amount of greater than $445, so this is where it kind of, if you sit back and have a look at it, because it's easy to do calculations really quickly and get something wrong. If it's more than $445, you've done something wrong. You've added something when you should subtract it. And you can do a logic check on it as well. If you've got a taxpayer that's earning $60,000, but you've got a low income tax offset of $400, that doesn't make sense. Because the maximum amount is $445, but $60,000 is closer to the end threshold, kind of going, no, that should be lower than that, because we should be moving towards zero. So sometimes tax, and particularly when you're doing things quickly, it's sometimes worthwhile kind of taking a step back and going, hang on a minute, does that make sense? Like Medicare levy. Sometimes if someone had looked back and said, oh no, hang on a minute, that's 20% of my income. Oh, I forgot to put a zero in my decimal points. But there are a lot of people who won't sort of step back and go, that doesn't make any sense. Okay? If you know what you're doing, then you see those errors when they occur. If you do things blindly, if you learn the calculations by rote, you won't see those sorts of errors. Okay. Next one is if he's on $78,000. Tax payable, so $78,000 is still in that 32.5% band. 78,000 less 37,000 at 32.5% at 3,572 gives you your 16,897. Add the Medicare levy at 2% gives you 1,560. But in this case, the taxpayer is above that low income top threshold is 66,667. So no low income tax offsets available. Make sense? All right, like just to add something in, so if, yeah.
Which page was this example?
Oh, the example's on page 61. Oh, yeah, of the current year payout. If anyone is relying on prior year information for anything, so whatever it would be, please be aware that the next thing that we're going to talk about is new in this year. It wasn't there last year. So if you're looking at an old master tax guide or something like that, you won't find this next offset in there. Now, in addition to the low income tax offset, we have a low and medium income tax offset. It is a result of an announcement that came from the budget last year. In terms of trying to reduce the bracket creep. So basically what the government's trying to do is to recognise that Australia has very high individual tax rates, which kick in at quite low levels of income compared to other OECD nations. So we've been steadily, over the last, I'd say 15 years, steadily increasing our thresholds where those higher rates of tax come into effect in recognition that the median level of salary has increased. So as a result of the budget in May last year, there were some announcements which provide some additional concessions for taxpayers to recognise that they're on lower levels of salary compared to the median, and over the next couple of years to allow some increases to those thresholds. So this year in the 2018-2019 year, the thresholds have increased. So where the 37% level kicked in, it was 87,000. This year it's 90,000. And if you have a look at what it intends to do over, so the next 2 years is nothing, but in 2021 and 2022, our thresholds are going to increase quite significantly in terms of the top marginal tax rate of 45% is not going to kick in until you earn in excess of almost $300,000. Okay, so we're really sort of extending those thresholds, but it needs to be planned in advance so they don't create huge holes in their budget now. It's been passed by legislation as well. In the meantime, to compensate people that those thresholds aren't increasing fast enough, they've introduced a new or an additional offset for low and medium income tax. So the low income tax offset is still there, the 445, and it will still be there. This is in addition to it for those people that earn slightly more than the 66,667. So let's have a look at it. Anyone with taxable income under 125,333 will get access to a part of this particular offset. It looks confusing. And it is, relatively speaking, confusing compared to the low income tax offset. But I actually worked through it to try and sort of do a comparison of the two. So basically what it's saying is anyone on $0 to $37,000, which is the lowest threshold for the low income tax offset where you get $445 automatically. In addition to that $445, you'll get $200 under this offset. So your total offsets will be $645. Yeah, it's a flat rate. Where you earn between $37,000 and $48,000, under this offset, you'll still get the original $200, but you will also get an additional 3% of every dollar over $37,000. So this is not a sliding downward scale, this is a sliding upward scale. But what it is doing is it's counteracting the downward movement of the other offset. So under the other offset, for every amount that you earn over $37,000, your offset reduces by 1.5 cents. In this particular offset, it says for every dollar you earn over $37,000 and under $48,000, this offset increases by 3 cents, which means you're getting an additional offset of 1.5 cents. Yeah, just another thing to add in there to just make things confusing. Once you hit $48,000, you top out this offset. It tops out at $530. So the maximum amount you can get under the second offset is $530. Yeah. Once you go over $90,000, so up to $90,000, you get the full amount of $530,000. Up to $66,667, you will also get some portion of the low income tax offset. Add them together. Once you hit $66,667, you only get this amount of $530, but you get something, which you previously didn't. Once you go over $90,000, then you're no longer getting the low income tax offset anyway, so you've only got this one, and this is where we've got the sliding downward scale. Why they didn't just remove the old low income tax offset and put a new offset in, blows my mind, but they didn't. Because they wanted to make sure that Curtin University students who were studying tax had some complicated calculations to go through. There's always easy ways to do it. Anyway, won't even get it. So we use this particular schedule in the same way we use every other schedule. Work out what band they are in and use the relevant rate. So if they sit between $48,000 and $90,000 for this second offset, $530 is what they're getting. Yeah? So I've provided some reasoning about why it's done, but it is as simple as working out which band you fall in. The offset's calculated using that particular figure. Yeah? By 2022, when you're in practice and you've got used to using these two calculations, this will be removed, the low income tax offset calculation will be removed, and it will be replaced with one table. But you've got to wait 4 years, 4 years before we get to use it. All right, so if we have a look at example 1.10 on page 63 of the of the PIAT, there is an example of how this calculation works, and the examples that are provided in there show the use of the two low income tax offsets calculations. I'm not going to work through those particular examples. I'll use them as a reference when you're working through your questions, but when we work through some of the example questions, we'll come across it. Just some examples of different levels of taxable income and what it's going to give rise to under these particular, under this new LAMO tax offset. LAMITO. We call LITO, the low income tax offset, we refer to it as LITO in an acronym. So LAMITO, we'll call it that. So at $32,000, they get $200 in addition to their general low income tax offset. At $46,776, there will be some reduction to their low income tax offset because they're in the band, which will be offset by this offset. That offset's reduced by 1.5 cents. This offset is then increased by 3 cents. So their net increase in their offsets is 1.5 cents between the two of them. So their offset is $493.28, together with whatever your calculation is of your low income tax offset. At $79,543, because we're between the $48,000 and the $90,000, they get the flat rate of $530, but you'll find there's no low income tax offset because they exceed that top threshold. And anything over 123,259, you sit below that top threshold, and the 530 is reduced by 1.5 cents for every dollar above $90,000. So in this case, $31.11 because we're approaching that upper threshold. Yeah? So often it can be quite handy to actually, like if you've got the slides and you can print it out, just to cut this out and maybe sort of put it in your book as a reference to those levels of income, which will give you a quick ready rec now when you're doing questions about whether you're sort of close to what the calculation should be. All right. So that's it in terms of income. Covered off on all of that. So just before we take a break, I actually want to take the next 15 minutes just to work through 3 of the questions in your PIAT. I didn't post them on Blackboard because I wasn't sure how far we'd get through income today. So this is going to be on the fly together. We're going to work through the theory behind it. Do you all have PIATs? Yeah? You don't? Okay. So we are going to, I'm just going to run through questions 8, 10 and 13 in PIAT, which are comprehensive questions including different kinds of income. So the answers that are available on Blackboard are presented in the standard format that we do all our income calculations, our taxable income calculations. So question 8 is on page 82 of your PIAT. And it is Maggie, who has a number of income and deductions. We haven't covered deductions, so any deductions that are referred to here will be based on the assumption that they are fully deductible. So, got the answer on the board and we'll go through that, but let's just talk through the theory and how we would work through a question. So, before I go through each of the individual items, I just want to work through like if you're in an exam and you're writing this stuff down, because I know in terms of writing an exam, I was there not that long ago writing stupid essays for exams, much faster typing things. But in terms of the amount of time taken for this particular unit, half your time is taken writing. You know, if you get used to the format and the structure, and that comes naturally, and it's really easy, like second nature to you, you have a lot more time to spend thinking about what you need to include and what you don't. Okay? So you really want to make sure you've done enough practice and you understand the formatting of the questions so that that is all second nature, and it really is about thinking about how much you're going to include in respect of each item, whether zero, whether all of it, whether a certain part of it, and the reasons why. Our formats are the same for all of our tax calculations. The top part of our calculation is always all of our assessable income items. The bottom section of our calculation is always our allowable deduction items. Yeah? So I just say to everyone, take a page to do your tax calc. You know, you can ask for another answer book. You don't have to cram it all into, you know, half a page. We're not saving trees in terms of exams. So take as much room as you need to. Every item that you come across in your question, so every figure that's referred to in your question, needs to be shown on a separate line item. It might very well be that the value you ascribe to that figure is zero because it's not assessable income or it's not an allowable deduction. But you need to show me why, that you've considered each item. I don't know whether you've forgotten it or whether you know why we don't include it. Okay? So every item that you come across in a question has to be shown somewhere. You can do it in your actual calculation, which is generally the easiest way to do it, or you can do it by way of note. Some people like to keep their calculation clean and have little notes on the side. I suggest you do it all as part of your calculation. So write the line item and then consider the amount you're going to include as assessable or deductible. If it's zero, write a zero, but give me a reason why it's zero. The reasons I need for income is either, so if you're including an amount, I don't necessarily need a reason why you're including it because I can see you've included it. That's okay. But if you've put a zero next to something, tell me why it's zero. Is it exempt? If it is, write exempt next to it in brackets. That gives me the reason you know that a Defence Force reserve payment is not included in your assessable income because it's exempt. Tell me that. You have not included your lottery winnings because it's a windfall gain. Right, windfall gain. That's the reason why you're excluding it. Yeah? It's a private amount. So if it's pocket money, write next to it that it's private. If it's a capital gain, so if it's an amount paid for the tree as opposed to the fruit, it's not included in your assessable income because it's capital in nature. So they're generally the 4 reasons why you're excluding things. I'll check on Blackboard to see whether, I don't think Colin's posted. When I teach this class for my undergrads, I've got tables for all of the income items we deal with and all of the deduction items we include. And the table basically says, this is the amount, is it assessable, yes or no? If it's not assessable, what is the reason it's not assessable? And then it talks about the derivation, so what's your timing of it? They are useful ready reckoners when you're working through these examples early on. You can't take them into the exam, but they can be a helpful tool to kind of summarise it all. So if they're not on Blackboard, I don't think they are. I did have a look around for them this morning. I didn't see them. I will post the income one under the income section and the deductions one under the deduction section so you can see. All right. So we set out our assessable income. We set out our allowable deductions. So you can see here we've got our assessable income amounts. We've got our expenses. So in this case, it's just one sole line item, but when we do deductions, there'll be more. Get to our taxable income figure. Note, all of those figures are in whole dollars. At the bottom of that calculation, once you've done it, then you do your tax calculation. It's always set out the same way. Your very first part of that tax calculation is your tax on your taxable income. Dollars and cents. Even if your cents are 00, make sure you show it so we understand that you know it's dollars and cents. From that, or to that, we will add Medicare levy. I don't necessarily like the way these answers are presented because they don't show every line item if it's not applicable. In this case, Medicare levy is not applicable because her income's below the level. If you want to get into the habit of remembering everything early on, I suggest that you include the line items for everything. So even if Medicare levy is 0, put Medicare levy 00 and right next to it below the threshold. Because when you come to review those answers, you'll go, oh, did I just forget it or did I not include it for a reason? And that just provides you your review notes. In the exam, don't include it, doesn't matter. But for review purposes and while you're sort of getting the understanding of it, it's helpful to write it all out. Okay? So I would have Medicare levy in there with a 00, and then we will subtract off any offsets available first, and then any credits. In this particular example, we don't have any credits, so there's nothing there, but we do have both versions of the low income tax rebate. So let's work through this question. So Maggie had following income and deduction, salary of $25,000. We all happy that's successful? Yep, so section 6.5. So you'll notice in the answers that the section reference is next to it. Reimbursement of work-related kilometres travelled. So this is that one reimbursement that's not a reimbursement. We treat it as an allowance. Okay, so don't go, oh, it's a reimbursement, I'll exclude it. Make sure you understand what it is. This is a reimbursement on a cents per kilometre basis, so we treat it as an allowance. So $1,900 is going to be included in there under section 1570. Interest of $1,000, assessable, 6.5, ordinary provisions. Then we have Army Reserve income, exempt. Yep, so we would include it as a line item with a 0, and we would write a reason next to it. I just put reason in brackets, exempt. You get the mark for that. Yeah. And expenses which are fully deductible for tax purposes of $2,800. So again, if I was doing this, I would have the 2,800 in brackets, show it's a negative amount, meaning that the taxable income for Maggie is 25,100. What tax rate does she fit into? 19%, so 25,100 less 18,200, which is our tax-free threshold, times by 19% gives us tax payable of 1,311. Next thing is to consider is Medicare levy. In this case, I'd have a line item in there, Medicare levy, and I'd write a note to myself under threshold 00. Okay. Next question you need to ask yourself, do any concessions apply? Concessions we deal with in this course are the low income tax offset and so the LITO and the LMITO. In this case, both, because we're under the $37,000 threshold for the LITO, so we get the full $445. It doesn't matter which order you show it in, because they're both concessions. So the $445 for the low income tax offset, and then the LMITO, low and middle income tax offset, sits in the bottom band, so the flat rate of $200, meaning that the total rebate is $665. Okay, so between the two of those, your maximum rebate that you're going to, or the maximum offset that you're going to get is $665. It will never add up to more than that, the way they work together. Okay, so the lowest possible income earners are getting the maximum benefit of that offset. So full $645, net tax payable for this taxpayer is $666, all shown in dollars and cents. Yep.
Why not LITO and why is it LMITO?
So LITO, this is the LITO, low income tax, this low income rebate. Sometimes that's why sometimes these questions, because people use different terms. The low income rebate is the low income tax offset, LITO. So yeah, if you wanted to sort of cross that out in the answers and changed it, but it's exactly the same thing. So if you see the term low income rebate, they're referring to the LITO. And sometimes it'll be LMITO, so low and medium income tax offset, or it can be shortened down to LMITO. Same thing, used interchangeably. So can they get both of them? Yes. Yep. So both work concurrently together. Basically, when you put them together, the maximum amount that anyone can receive as a concession is $645. So these two amounts together. Once you start going above the $37,000, you get a reduction of one and an increase in the other. Okay, so it's to sort of make sure that we give them that benefit. So one comes down, one goes up. Like I said, why they just didn't wipe it all out and put in.
Does it mean, do we need to calculate both the stuff or?
Yes. Yes, where the taxpayer's taxable income is below 66,667, you'll have two. Where the taxpayer's income is above 66,667 and what's the other one? 120. It is. I haven't been dealing with it long enough to remember it. 125,333. You will only have the LMITO. So this one. Yeah.
So what was it for element?
What was the value?
Yes.
Well, it depends on where the income band sits. Depend on the value. Oh, so if the taxpayer's taxable income is below 37,000, you'll get LITO and LMITO. And you get the maximum amount. If the taxpayer's taxable income is between 37,000 and 66,667, you will still get both amounts, but there will be a reduction. Where the taxpayer's taxable income is in excess of $66,667, you will only get the LMITO. And that you'll only get a portion of that up until you reach 125,333. Once you go above that, you get neither. Confusing. It needs a graph. It needs one of those tables where you kind of colour it and say, okay, both, one, none. Draw yourself a graph. I like colour. Mutually exclusive Venn diagrams, it might need one of those. They teach you that in stats? Oh no, that's something else, isn't it?
Yeah, it's this week we're doing that actually.
Oh, Venn diagrams.
Yeah.
Oh, yes. You can tell I've already talked about them. You're all over it. All right, so let's have a look at Stephen. And the reason I've chosen Stephen is because there's a couple of terms in Stephen's details that you might not have come across before. So, Stephen received the following amounts during the financial year. He received an allowance from Centrelink while unemployed. Is that assessable?
Yes.
Yep.
Right, I guess.
Yes. It's new start allowance.
Yep.
Think about what it's designed to replace. It's designed to replace salary and wages, so therefore it is going to be assessable. An honorarium as a treasurer of a charitable organisation. Who hasn't heard the term honorarium? Okay, so they use lots of terms for ad hoc payments they make. Honorarium, stipend or stipend, depending on how you want to pronounce it. Per diem, which is the Latin for per day, so there's a payment that can be made per day. They're all payments. Now what you need to consider is it will be assessable if it is a payment for services rendered. Yes? Unless there is a particular provision of the Act which takes it out, which sometimes there is. There are some tax laws which take it out. But an honorarium paid to a treasurer of an organisation in a voluntary capacity basically says we recognise that you put hours and hours and hours of work into doing this job, and it's a thankless task that we don't pay you for. But, you know, here's $50 to go and buy yourself some alcohol to make up for it. A couple of bottles of wine to make you feel a little bit better at the end of the week. It is a token gesture. that is made by such an organisation to recognise that they put this service in and don't get rewarded or remunerated for it. Even though it's a token gesture, it is a reward for the services they provided, even though that it might not represent the value of the services provided. Therefore, it is accessible. Okay? In the same way, if you're a waiter or a waitress and you receive tips on top of your normal salary and wages, that is accessible because it is for services rendered. Yeah? So the honorarium is accessible under 6.5. There are certain tax rulings out there which tell you certain organisations can pay honorariums and they won't be accessible income. I talked about a stipend or a stipend and a per diem. Per diems are amounts that might be reimbursed to you on a daily basis as a result of you not being able to work. If you go for jury duty, you get paid some token gesture amount for having to sit in some god-awful courthouse listening to some god-awful case, and the amount you get paid doesn't represent your lost earnings, but that's what it is. So all of those things, if they're designed to replace your salary and wages, will be accessible income as well. Lump sum damages for personal injuries sustained in a car accident of $6,200. Do you remember what we said about compensation? If it replaces wages and salaries, it's accessible. Is this replacing wages and salaries? We don't know. We're not told. It's not broken down. Some of it could be lost wages and salaries, but because it's not dissected, it's all treated as being capital in nature. So we'd have a line item there, lump sum damages, but the reason we'd exclude it is because it's capital in nature. It's undissected. However, if you had an amount that said $3,000 for lost wages and salaries and $3,200 for personal injury, the $3,200 would be capital, but the $3,000 would be accessible because it represents replacement of salary and wages. So where it's dissected and you know what the amounts are. Okay, a lump sum legacy under the will of a deceased relative. So I picked this one because it uses the term legacy. Some other questions will use the term bequest. Some other terms will say inheritance. All of those sorts of things are amounts that come out of the estate of a deceased person. Those amounts that come from the estate of a deceased person will always be capital in nature. Okay, so we don't include them in our accessible income because they're capital. We'll talk about deceased estates when we talk about trusts a little bit more later on. But if you see a legacy, a bequest, an inheritance, exclude it from your calculation or with a value of 0 because it's capital in nature. Unfranked dividends from family PL. So we've just talked about dividends today. We're including them under section 44. The unfranked dividend will have one line item only and just the amount of the cash dividend. So we're going to include the unfranked dividend of $8,000. Nothing else to do with it. We don't need to include anything in our tax calc down the bottom. However, we also have franked dividends from Australia Bank of $6,000. So section 44 will include the cash amount of our dividend, $6,000. And then 207.20 subsection 1 will make us include the gross up for the franking credit attached, which we were told is $2,571. So we will add it as our second line item. Assuming there's no allowable deductions, we're not provided with any in this particular question. The total taxable income for Stephen is $19,671. Slightly above the tax-free threshold. So we're going to have some tax to pay. So now we move into the tax calc. Tax on taxable income is $19,671 less $18,200 at 19%, which gives us our $279.49. Has access to both the low income tax offset and the Lamito. So a maximum of $645. However, given that they're offsets, you can only utilise those offsets until they bring our tax payable to nil. Because anything more than that will generate a refund, and we can't generate a refund from these offsets. So he can only take advantage of $279.49 of it. So whichever way you want to do it, it might be the $279.49 of the $445 LITO that he has access to, and then he misses out on the Lamito. Or he might get the $200 of the Lamito and some of the LITO. It doesn't matter. Just make sure that you don't claim more than the $279.49. So it reduces your tax payable down to zero, but can't generate that refund. And this is where the order becomes really important, okay? So you need to have done this calculation and then compared it to the tax payable before you move on and claim the credit. This taxpayer also had dividends, franked dividends. That franking credit, or the tax paid by the company on his behalf, can generate a refund. So this takes the tax payable down to zero, which means he can get a full refund of those franking credits, the 2571. Yeah? Good-o. The last one I wanted to do, because the slides don't actually cover, there's another offset that we have for businesses. Actually, did I skip? I might have skipped a set of slides. I did. So I need to put it all in one. All right. Income. The last part of that income stuff we're doing deals with some particular provisions that relate to a business. So even though we're dealing with individuals, you're all happy that individuals can run a business, yeah? So the entity itself doesn't determine what happens. It's just a product. So an individual can run a business as a sole trader. And business income is treated slightly different to salary and wages and other kinds of income. So what constitutes a business? Generally, a business needs to have some kind of profit-making intention. Okay, so it's not a passive kind of investment structure. Usually, it's an active activity that with the intention of making a profit. Whether it does or not is besides the point, but there is generally an intent to make a profit. Whether a business is being run or whether we consider it a hobby, because you can often find that people will have a hobby that they develop and they realise that they're so good at it that they end up making a business out of it. At what point in time does it go from being a hobby, where it's not accessible, to being a business? Well, that's a question of fact. For our purposes, we won't ever have to work through that being the case, but we will. You'll be told if a business is being conducted. So basically, when you're looking at a business, is there repetition or regularity? The size and scale of the operations will generally indicate whether there's a business. Whether you're operating under a business name, have separate bank accounts that indicate that you've got a business. If you're holding yourself out there to the general public as running a business, those will be the general signs that we will look at about whether a business is being run. The main reason why we need to have an understanding of businesses is because the way we record it, or the derivation of the income, is slightly different to individuals. So salary and wages for individuals are derived as the income is received, no matter when the services are provided. So even if you get a back pay for 2 years ago, for income purposes, we include it as assessable income in the current year. Businesses generally record their income and their expenses on an accruals basis. So basically, once the services are performed, that's when the income's been derived, irrespective of when you receive payment. That's why we create accounts receivable in our accounts. So invoice, that's when the amount's received. We might get paid 14 days later. Okay, so it's an accruals basis for most of our income. So for example, if you have a furniture business that has a special offer, the buy now, pay 10%, and the remainder is payable over 3 years. The deposits received at 30 June is $10,000. The amount outstanding is $90,000. How much is derived in the current year? $100,000 in most cases, because it's an accruals basis. You've made the sale, so irrespective of what payment terms you've agreed to, generally the point in time that you make the sale is the date that the income is going to be accessible. This kind of example can create some cash flow issues for the entity because they pay tax on money that they haven't yet received. And there's a significant delay. There are some specific kinds of businesses that derive income in a different way. So situations where amounts are paid in advance for services to be provided down the track can often have a deferral of when you include them for income tax purposes. So for example, if you pay for classes that you're going to take over the next 3 months, but you pay it before 30 June, the business receiving that payment, as long as they meet certain conditions, can actually release that income as they provide those classes over the period of time, rather than including it all up front when they receive the payment, so it better reflects. 2 conditions need to be present for that to happen. One is that they need to record the income in their balance sheet as effectively as a prepayment of their services or unearned income. And secondly, they need to offer refunds if the services aren't provided. Those refunds don't need to be like in any circumstance, but there has to be the potential that a refund could be given. The reason behind that is the ATO says if you're in the business of charging up front and you do not give your clients any refunds, then you know for certain at the time of receiving it that that's the income you're going to receive. It's the level of uncertainty that allows you to defer the payments of it. So if there's any kind of uncertainty, meaning that someone doesn't complete the series of courses and you have to refund some of their money, if you recorded it all up front and then had to do that refund, you'd have to go back and amend it. Okay, so they allow you to extend that particular purpose. Certain other kinds of businesses are allowed to account for their income on a cash basis, so when it's received. 2 kinds of entities: professional services entities and personal services entities. So those services providing, or those businesses providing services as a result of personal skill, doctors, dentists, vets, those sorts of things. So they're not providing goods, they're providing personal services. And professional services. So these also tend to fall into those personal services, but lawyers, accountants, architects, all of those kinds of people that are deriving their income as a result of personal exertion as opposed to buying and selling goods and inventory and that sort of thing. They are allowed to account for their income on a cash basis, personal services entities all the time, professional services entities where they're considered to be small. So a sole practicing lawyer or accountant or a 2-partner practice. KPMG, Deloitte's, no. They have to account on an accruals basis because they've obviously got to that point where they're so big, they should be using the same methodology as everyone else.
So if it's a small business, professional services, it's
Yep. Yep, so and when we say small businesses, we're talking about maybe 2 partners max with maybe 2 or 3 employees. Yeah? As a guide. Be pretty obvious. We also have an overlaying provision which sits over our businesses, which provides some additional concessions for smaller businesses. We call them small business entities or SBEs, small business enterprises, and they actually have a few alternatives and concessions that they can use. So under these provisions for SBEs, they can choose to use the concessions or not. And they can opt into each concession or choose not to use it. So it's not it used to be an all-in basis. So if you chose to be an SBE, you had to use all of the rules. Now it's a case-by-case basis you can. So we'll come across a couple as we go through different provisions. You have to be carrying on a business with a turnover of less than $10 million. Turnover means your income line. So if your income line in total is under $10 million, that's where turnover occurs. Generally, we average it over a 3-year period to take out any dips, peaks and troughs where you're close to that line.
So it's turnover considered across or not?
Sorry?
So the turnover?
Turnover is just income, not net profit, doesn't take into account expenses. Turnover is that top line item, all of your income amounts. So just assessable income is basically all you use to determine turnover.
Is it for in 1 year or?
Generally, we average it over a 3-year period. So we'll look at turnover of the current year and the previous 2 years, divide it by 3 to get that turnover. Like I said, cyclical businesses where there's peaks and troughs, it's designed to take it out where they sit close to the threshold. Yeah. But you'll be told if it's a small business entity, you don't have to work it out. The elections that can be made or the concessions, trading stock, which will come to in deductions. Prepayments, again, will come to in deductions. CGT, when we deal with capital gains tax. Depreciation, when we deal with the UCA provisions. And there is a small business tax offset, which we're going to have a look at in a minute. SBE entities can choose to use a cash basis to account for their income as well. So they can choose not to use accruals, but use the cash basis, so they record income when it's received and expenses generally when they're incurred. So, in addition to the low income tax offset and the LMITO, there is also an offset that's available for SBE taxpayers. It is a maximum offset of $1,000, but you have to do a comparison of 2. So it's the maximum of $1,000 or 8% of your tax payable. So you get a concession of 8% of your total tax payable or $1,000, whichever is greater. Okay, so you need to work through a calculation which effectively works out the proportion of your total business income over your taxable income. For a lot of businesses, it'll be 100% because all of your income is business income. But for some taxpayers, it might be a proportion of it. So it might be that you've got interest and dividends as well as your business income. Or that you run a business, so if you're like me, you run your own business, but you also receive salary and wages. So I teach here and receive salary and wages for teaching here. I'm a director of a public company for which I am paid salary and wages, but I also run my own accounting practice. So I've got a combination of the 2. And it might give you a proportion of 50% or 60%, something like that. But you have to work out that proportion first because your offset is only available on the tax payable on your business income, not on your other income. Calculate the tax payable on your total net small business income. So you're going to have to work out what your tax liability is from your total income and then apply the proportion that you worked out in step 1. So if your total tax liability on your taxable income is $30,000, but your business proportion is only 50%, then $15,000 is the tax attributable to your business. And that's all you can claim the offset on. And then once you've got that proportion, then you can work out whichever gives you the best result. So $1,000 or 8% of that total tax payable. So if you had $15,000, 8%, I worked out in my head. But it would be more than $1,000. So you would claim the lesser of the 2. So $1,000 is the maximum offset you can get.
Did you say less than?
So
Either
your
8%, whichever is lower, or
whichever is up to a maximum of $1,000. So if your 8% of your tax liability is lower than that, you can claim $1,000 is the maximum you can claim. So if the 8% of your tax liability is higher than $1,000, it has to come back to $1,000.
So what if it is $950?
Then you claim the $950.
So whatever.
Yeah, whatever is lower. Let's talk about LMITO and LITO and then try and talk about SBE offset. Confused. So if an SBE taxpayer has net income of $28,450 from their business and $63,210 in total taxable income, then their proportion of their business income represents of their total income, in this case is 45%. So it's always your business income divided by your total taxable income. So this is an example where you've got someone who obviously runs a business and derives significant other income, probably from being salary and wages. Yeah. So 45% is what represents their business income. So on a taxable income of $63,210, So when we talk about basic tax liability, you just use your tax thresholds to work out the tax payable on that. So it's your gross tax payable. Don't worry about Medicare levy or anything else on top of that. So $63,210 less $37,000 at 32.5% at 3,572 gives you your basic tax liability. In this example, it's $12,090.25. Basic tax liability. That's your total basic tax liability. So we want to work out what relates to our business. If we know the proportion of our taxable income over our proportion of a business income over our total taxable income is 45%, we can assume that 45% of that basic tax liability relates to our business income. So $5,440.61 is our tax liability. 8% of that gives us $435.25, which is what we're going to claim because it's lower. If that ended up being larger than $1,000, our rebate or our offset would be limited to $1,000. Yeah? Happy with that? All right, I've kept you too long on income. So when you work through your tax calculation, you've already worked out your tax liability, which is $12,090.25 using our basic tax rates. To that, we would add Medicare levy. It's not in here, but clearly they would be paying 2%. Once we've done that, we can then apply our offsets. So they would get access to the SBE offset, the LITO. The example's missing the LMITO because they would get access to that as well. Because all of them are applicable, they're sitting below that threshold. So that example done. Let me change it, and we'll I'll repost it. I found a few errors with these slides. Whenever we get something new in, sometimes we forget when we're. Yes, I'll get it updated and repost it on Blackboard. But more importantly is that you understand how this calculation works. So really, a lot of people find it very difficult to get their head around the SBE offset, but all it's trying to do is to say, well, this offset is only available for your business income. So really, the most important step of that calculation is making sure you get your proportion right between your total taxable income and that portion of it that relates to your business. If it's 100%, it's easy, but it never will be because we don't like doing things like that. All right, okay, so let's take a break. And then we'll come back and get started on deductions. So what time is it? 11:54. We'll come back at 10 past. And we'll try and sort of power through deductions.
The charitable organizations.
Yep.
There was this example that we just went through.
Yep.
You know,
The honorarium.
Yeah.
Yep.
Is it, if it's from the charitable organization. Is it not exempt?
No, because the exemption isn't determined by where it comes from. It's by who's receiving it and what kind of income it is. So the honorarium might be coming from an entity that's exempt from tax, but that doesn't mean any payments it makes is exempt, because you have to look at it in the hands of the recipient.
Okay.
So in that case, the recipient was an individual, so there's no exemptions available for them, and that's why it's accessible.
Unless if the income itself is exempt.
Yes, yeah. So if it's one of those categories, so alimony or spousal maintenance or defence force reserve, then yes, that's when it's treated as exempt. Okay. All right. No problems. Let's get started again. Right, we all caffeinated? Because I'm going to talk really fast. Otherwise we're not going to get, because we've got next week to finish off deductions. So I am actually not going to be here for the next 2 weeks. So this isn't actually officially my class, it's someone else's class that I'm taking. So the next 2 weeks I've got directors meetings, so I won't be here. Colleen will be taking the class for the next 2 weeks, but I'll be back after that. So we need to get through deductions today, for the rest of today and next week. We've got to get through deductions. So I'm going to take you through the core provisions today, and some of the more specialised provisions we'll leave until next week. All right, so we talked about income being in the 1997 Act. Deductions are the same, so it's been moved to the 1997 Act. It is contained in Section 8.1. So there are the general provisions relating to deductions. It's what we rely on unless there's specific provisions within the Act which allows us to claim deductions or denies us deductions specifically. So we'll be going through Section 8.1 and how that works. We will then be moving through Section 25, which is a list of specific deductions that are allowed per the Act, and Section 26, which is a list of provisions which specifically deny us deductions under the Act. So they're the general ones, and then there are other provisions dotted within both pieces of legislation which allow us to claim deductions for certain things. If anyone's done their own tax return, you would have come across some of them. Particularly in relation to uniform expenses, maybe motor vehicle expenses, what you can claim, what you can't, maintaining a home office. Donations, you'll get receipts when you make a donation that says donations over $2 are tax deductible. There's a reason for that. They're not just making that stuff up. So there is actually provision within the Act that deals with it. So we'll go through each of those. And then we've got certain provisions where we're going to have to work through calculations. So self-education expenses, prepayments, those sorts of things along the way. So Section 8.1, now you are going to have to go back and have a look at the legislation in relation to deductions and just see how it's set out. But the way the general deduction provision works under 8.1 is it has what we refer to as 2 positive limbs, and then it has 4 negative limbs. So we start with 2 buckets, and we've got the marbles in our buckets, and there are 2 positive limbs. And then our 4 negative limbs are where we take different coloured marbles because of various reasons out of the buckets. Okay, so this is one of those ones where you start with empty, put them in, and then take stuff out because that's the way the rules read. So the 2 positive limbs contained within Section 8.1 says we are allowed to claim a deduction for expenses that are necessarily incurred in relation to producing our assessable income. So any expense that we incur in producing our assessable income is potentially allowable as a deduction under the general provisions within the Income Tax Act. The first positive limb, the one I've just talked about, is subdivision A, and it deals with non-business income. So things like salary and wages and investment income. The kinds of expenses that are incurred in relation to producing assessable income might very well be the purchase of uniforms that you have to wear at your work. It might be that if you're a teacher and you have to purchase your own stamps and stickers to reward your students, that would be a deductible item. There is nothing within this particular provision in the Tax Act which is subjective. So it doesn't say what you can and what you can't claim and what's reasonable and not reasonable in relation to your employment, as long as it's an expense that you incur in relation to your work-related activities, then A1 will allow you a deduction. Okay, so it's not prescriptive in that basis. The second positive limb effectively deals with business income. So the first one deals with producing your assessable income. The second limb basically says any expense necessarily incurred in generating your assessable income from business. It's effectively what the second limb is doing. So whilst one limb's probably works for both scenarios, they have deliberately split it up so it makes sure that we deal with both. The rules associated with claiming deductions for a business are a little bit more lenient than those related to producing your assessable income because they take into account those indirect expenses. So it might be that you run your business out of a factory unit, but it picks up those sorts of things like insurance and electricity and stuff for running that building, because without it, you wouldn't actually be able to generate your business profits. Yeah? Whereas producing salary and wages is a slightly less, there are less expenses that go into relation to producing those. So, it's not prescriptive. Legislation doesn't say how closely related it has to be. It just says incurred in relation to. So you have to understand the concept incurred. It means that there is an indefeasible right for payment from the person who's provided the supplies, the goods, the services. So basically it's incurred. It's something that you have paid out in relation to your business. It doesn't say that it's compulsory, so it doesn't have to be a payment that's compulsory. It's like a voluntary payment that you make for something relating to a business, satisfies that definition. But the term incurred is important in the same way the term derived is for income. It tells us when we can claim that deduction. So it might be that you haven't physically paid for something, but if you've incurred that expense, it's deductible. So you might incur it now on the 28th of June, but not pay for it until the 14th of July. Yeah? Basically means that the goods have transferred hands and that the person who supplied you can actually lodge court action for you to pay the bill. You want to think of it in those sorts of terms. Okay, so the non-business income, the legislation specifically says you can deduct from your assessable income any loss or outgoing to the extent it's incurred in gaining or producing your assessable income. So for salary and wages, it includes tools of the trade, it includes business subscriptions. So like I'm a member of the Institute of Chartered Accountants, so my membership to the Institute is deductible. I'm a member of the Tax Institute, so that's deductible because it relates to my income earning activities. If I buy any of these books or legislation, it's all deductible because it relates to my income earning capacity. So all of those sorts of things. In respect of non-salary and wages like rent, dividends and those sorts of things, dividends you might be able to claim interest on any monies you've loaned to purchase the shares. In relation to rent, it's quite common to have negatively geared properties, which means that you can claim the interest on the loans that you've used to purchase that property, repairs and maintenance for the property, those sorts of things. Okay. Bank interest, you may be able to claim a deduction for any fees charged by the bank for holding those funds. The second one is losses or outgoings necessarily incurred in carrying on a business for the purpose of gaining or producing your assessable income. So same intent, slightly different wording to make sure they cover both scenarios. There does not need to be a relation to the deduction and the year of income to which it relates to. So again, you can have a deduction claimed now, but effectively it doesn't relate to some income that you're going to earn in the future. So you don't have to match it. We're not as strict on that as accountants are. So you can pay for insurance now, but it can relate to 12 months in the future. You can pay for marketing services now, which are then going to be provided over a 12-month period. Or you can pay for something retrospectively. So it can be something that has been provided, but you're only just paying the bill for it now. So you don't need to match it. the deduction occurs when you have the incurrence of that particular expense. Just some examples of things that might be deductible expenses. So keep in mind we talked about illegality or not being something that prevents something from being accessible. So it also doesn't necessarily prevent something from being deductible. We'll come back to La Rosa's case down the track. But what sorts of things do you think employee teachers might be able to claim deductions for? Sorry? What do you think teachers might be able to claim deductions for?
Stationaries.
Yep. So any stationery that they pay for in their own right. So as long as they're paying for it out of their own money, a teacher is required to be registered. Yep. So whatever their registration fees are with the Board of Education. If they buy any of the school uniform, so they might wear sort of logoed school uniform stuff. They might provide some of the ingredients for their wacky science experiments. I had a friend who's a science teacher over at high school, and she does some really cool experiments, but school doesn't provide the stuff, so she's always out buying chemical stuff to blow stuff up. All right, what about illegal drug growers or sellers? Is there anything they could claim? The electricity for running their hydroponic setup.
Bullets.
Guns, bullets, yep, any kind of security. Their Alsatian that they have on the property to prevent anyone from breaking in. You know, if they're growing it out in the open, any kind of gardening implements that they use to harvest their marijuana plants. Sun cream, yes, sure could claim sun cream in their hats. All sorts of things, their little baggies that they put stuff in. You name it, you think of it. They can only claim it as a deduction if they're returning the proceeds as income. So, yes, theoretically they could. Practically, probably, you don't want to advertise the fact that that's what you're doing. Rental property owners, think of anything? Yep. So rates, council rates. Garden maintenance, like get someone to come mow the lawns. Sorry, repairs. Yep, repairs and maintenance, but not capital improvements. We'll come back to that. Property manager expenses. So if you've got a real estate company managing a property, the commission you pay them to manage it. Yep. What about restaurant owners? Yep, so wages and salaries. Yeah. You'll have things like electricity, telephone, internet, all of those sorts of property kind of expenses, as well as raw ingredients for and packaging. Probably can claim deductions for consumables, and in that regard I would consider that plates and knives and forks and dishes and stuff are all consumables because they get dropped quite frequently. So all of those sorts of things, you know, pads that they actually write orders down on, all those sorts of things. Self-employed gardener. Yeah, so you have to be careful in terms of, yes, they can claim a deduction for any of the capital items they use in their business, so lawn mowers and stuff, but that would come under UCA, generally the depreciation provisions. However, their hand tools, so like, you know, the small trowels and stuff that they use, which, you know, you can often leave behind or drop down a grade or something like that, anything under $300 are considered to be consumable and are immediately deductible. Mulch, any of the materials that they use in terms of weed killer, that sort of thing, welly boots, overalls, sun cream, hats, those sorts of things to keep them protected. Accounting firm with 100 employees, wages, salaries, office space, which is expensive, stationery.
What about the computers? Does it come under capital?
Yeah, computers will generally be depreciable, but they will be deductible, so we would refer to them in the UCA provisions.
But does it not be a part of capital? Because it's the basis for which the company operates.
Yes, so they're not immediately deductible. What we're saying is they are deductible, but they're deductible over a period of time because a computer will last 3 or 4 years, let's say. So we just allocate the deduction of them over a period of time under the depreciation provision. So you're right, yes, they are deductible, but we're talking about outright deductions at this point. We will come back to UCA down the track.
So how about the accounting software?
Yeah, accounting software will generally be deductible as you use it, because you generally pay a yearly subscription for it, or a monthly subscription for using it. So if you pay for your subscriptions to their professional bodies for your employees and stuff, that would be deductible. Yep, stationery, you go through. Could never find my stapler when I was working at KPMG, so I reckon I used to go through about 20 staplers a year. They'd disappear off your desk. Someone would walk past and go, oh, look, I need a stapler, and then they walk off with it. I'm sure that there was a pile of staplers in like one of the stairwells or something. It's just weird. All right. The terms used in 8.1, some important terms, to the extent that terminology there allows you to apportion expenses. So if there's some part of it that's private, that won't be deductible, but the rest of it will. So it means that it's not an all or nothing thing. You can actually create some apportionment. And incurred, like I said, you're definitively committed to the payment. That's the point in time in which you can claim the deduction. Okay, so let's have a look at subsection 2, which is the negative limit. So the two, A and B, 8.1 A and B, are putting the marbles in the bucket. Anything that relates to those things go into the bucket. 8.1.2, subsection 2, has 4 particular components which will then take things out of the bucket. So you cannot deduct a loss or outgoing under this section to the extent that it is A, a loss or outgoing of capital or capital in nature. B, it is private or domestic in nature. C, it is incurred in gaining or producing exempt income. Or D, a provision of the Act specifically prevents you from deducting it. So they are the 4 provisions. Capital or capital in nature, it will not be claimable under 8.1. We may be able to claim it under another provision, like the UCA provisions. Generally we can. 2, private or domestic in nature. So if it's relating to something that is not business related. So the mortgage on your house, the interest on the mortgage on your house, don't use your house in earning your assessable income. Therefore, that is private or domestic in nature. You can't claim a deduction for it. You can't claim a deduction for your private clothing, for clothing that is not specific to your industry or to your job. You can't claim a deduction for your private travel from home to your workplace. It's not deductible, it's considered to be private. You can't claim a deduction for anything relating to producing exempt income, and that's kind of logical. If the income is exempt, then you shouldn't be allowed to claim a deduction for it. And lastly, the provision of the acts which prevent you from claiming it, and they're dotted all over the place. We'll talk about 26 hopefully today. So capital expenses are anything which are either a one-off expense or something that is going to provide an enduring or a long-term benefit. So when we talk about the purchase of assets, we're talking about things that are going to give us life over a period of time. It doesn't make sense in those scenarios to be able to claim an outright deduction for it. So if you've spent $100,000 on an asset and claimed it as an outright deduction, that doesn't represent the period of time over which it's going to provide income or assist in providing income. And that's why we have things like the UCA provisions, which then allows us to claim the expense of that over the life in which it's expected to exist. Yep.
So, but how about the land for a business? So, for example, if a business purchases a land, and so the land doesn't have any depreciation, just
yep. So that will be capital in nature, and you'll never be able to depreciate it. So what happens with land is that when you ultimately dispose of it, it gets caught under the capital gains tax provisions. So generally land will appreciate, it won't depreciate in value. So what will happen is you'll hold it, it sits on your balance sheet at that value, and then when you sell it later on down the track, you may be liable to capital gains on the growth in the value over the period of time. So we'll come back to that in topic 4.
Just got one more
Yep.
question. That was with regards to the previous one, the business.
Yep.
So, for example, if a parent company has a couple of subsidiaries and
Yep.
So how does they calculate income and expenses? Does it come under the parent company, or does each company under the parent has to do them separately?
I will preface this answer on the fact that it's not as simple as what I'm going to say, because there's another set of legislation that overlays it. But generally what happens is each entity is individual. So you calculate it at an individual entity by entity level. And if you have a parent entity that owns shares in the underlying entities, they calculate their income in their own right, and then they pay their profits up by way of dividend to their parent entity. That's basically how it works. Having said that, there's a whole other piece of legislation which is well beyond anything that you're going to do in this course, and even if you do your masters, it's not something that you cover in great detail, but the masters of tax, is the consolidation regime, which basically says we are going to, anyone that's like 100% subsidiary of other companies can actually consolidate and be treated as one entity from a tax perspective. And if that's the case, then they lump it all together, calculate income on all of them together. It's no different to what, it's actually not a lot different to what we do from accounts, because if from accounting perspective, when you've got parent entity and subsidiary entities, they consolidate their accounts and present it on a single basis. Our total income for the group is this. Our total expenses for the group is
So
this.
how about a company for Deloitte? Like they've got branches everywhere throughout the world. So does it mean these guys do it for every country, or?
That's, again, that's a whole, you're talking about a whole different structure with something like Deloitte's, because they are partnerships, they are not companies. So the people who own each of those Deloitte businesses or accounting businesses are actually the partners that are in that business at the time. So it's not like a parent entity with subsidiary entities. They actually all just share in the name. So it's very complicated. They pay money for the name. It's more like a franchise than it is a group. All right, private and domestic expenses. Private relates to a person, so clothing, childcare, food, holidays, those sorts of things. Domestic relates to the person's home, so rates on your home, mortgage interest, electricity in your home, that sort of thing. There are certain circumstances you can claim some of those expenses depending on whether you work from home or not, but as a general rule, you can't claim them. Travel to and from home to work is generally considered to be private in nature and not deductible. I know people say, oh, I'm travelling to work to earn my income, so it should be deductible. The answer to that is that you do not start your activities until you generally get to work. And so you are not deriving income while you are driving. So therefore, there is the connection doesn't exist. There are certain examples where that does happen. So if you are required to transport bulky equipment to and from work, so you are required to take a particular vehicle. So if you happen to be a tradie that hauls the cement mixer home every night on the back of a trailer, or welding supplies, or those sorts of things, and there's nowhere else to store it, then that will be deductible. Or if you happen to be the drummer in a rock and roll band and you've got to take your whole kit home, pretty hard to do that on the train or the bus, so you generally have to have your own transport. Double bass, cello, all those sorts of things that are hard to carry around, all of those sorts of things would, if you've got to transport them, your travel between work and home will be deductible. If you start your work or your job from home and then have to travel into work, there are certain exemptions, or you can claim that travel. So for people who are on call, it's not enough just to get a phone call that says you have to come in to make that trip deductible. You actually have to start part of your work before you leave home. So for example, if you are an IT technician at BP or BHP Billiton in the city, and you're on call for the weekend, and you get a very irate director in BHP because his computer won't turn on or won't work or can't get something off the server on the weekend, and he's already annoyed because he's in there on the weekend doing it. Happens often. If that particular employee tries to fix the problem from home first, so logs on using the internet at home, tries to fix it remotely, discovers they can't fix it remotely, and then has to get in the car and drive into the office to perform that fix, then that travel will be deductible because they have actually started their functions while they're at home. Yep.
So how about the car vigils and stuff considered in this?
The what?
The car vigil or whatever the money that they pay. The car registration.
Oh, they would be able to claim they potentially be able to claim a deduction for part of their car costs if they're using their own motor vehicle to get to and from work. Then yes, there's potentially a deduction available for the kilometres they've travelled using their private vehicle.
Provided the work starts at home.
Yes.
Right.
Yep. So, sorry, what was that?
Just the registration that they pay as a carry forward as well.
For the car?
Yeah.
it depends on how you claim your deduction for motor vehicle expenses. There's two methodologies. One is you use a cents per kilometre basis, so you work out how many kilometres you travel and get a set amount as a deduction. The second is logbook, so you keep a logbook of the number of kilometres that you travel for business purposes. Then every expense that you incur in relation to your car forms part of your base, and you apply the percentage to that to claim.
What plates does it pay for?
The number plates.
Yeah, the number plates.
Doesn't your car come with number plates when you buy it? Are you talking about personalised plates?
You gotta pay them every year, or like.
Yeah, that's part of the registration of your vehicle. It's not the plates you're actually paying for. You're actually paying to register your vehicle to use it on the road. Yes, that is one of your expenses that can form part of your base that you can claim it on. So registration, insurance, maintenance, depreciation on your car. I've put new tyres on, petrol, oil, all of those things, those costs of having a car can be a deduction, but only to the extent that it's used for business-related purposes. So we'll come back to how to do those calculations. Child minding costs are never related to earning income, even though you might need to put your child into daycare to be able to work. It's always private. In the same way that eating while you are at work is always private in nature, it's not related to earning your income. So your cost of lunch are never deductible. Trust me, I've looked to see whether I can claim them. Just get your company's credit cards and you buy all your lunch with your credit cards and get them to pay for it. Do it. Home study expenses. So there are two scenarios in relation to your using your house as a or being able to get a deduction for cost of your house. If you have or maintain an area in your home that is a home office, effectively, so you bring work home and you use that place as a dedicated space to do your work, then you may be able to claim some expenses, but those expenses are only running expenses such as electricity, heating, cooling, lighting, that sort of thing. None of the occupancy costs can be claimed, so you can't claim your interest on your mortgage or any part of the rent, you can't claim any part of the insurance of the house, that sort of thing. However, if you use your home as a place of business, which means you don't have an office located anywhere else, you run your business from your house, then it's a different situation that you can claim your running costs as well as your occupancy costs, so or a portion of. Generally, we can't claim 100% of it because you don't use 100% of your house to run your business, or you don't in most cases. So what you would do is you'd claim a proportion of your costs based on a reasonable allocation. Reasonable allocations are generally area of your house, so you'd usually claim it that way. But having said that, there are different examples of where area doesn't represent true value of the cost. I'll give you one example from a personal perspective. Both my husband and I run businesses from home. So I run my accounting practice, well, between the hours of 5:30 and 7 o'clock before I leave in the morning, I run my business from my house, and then it's usually in the car or on the run. But both run businesses from home. In terms of claiming deductions for electricity and that sort of thing, not for me, but my husband runs an IT business. And in our home office, we have 2 laptops, 2 servers, 4 monitors, which takes up an awful lot of our electricity bill, which contributes an awful lot to our electricity expense. So if the area in which we work represents, let's say, 20% of our home, but in fact, the actual electricity usage in that area actually represents about 50% of our total electricity costs. So claiming it on a 20% basis is kind of unclaiming what the actual cost is. So for us, the reasonable basis for claiming electricity was not on an area basis, but was on another basis. And we did that by basically shutting when we went away, we turned everything off in the home office and worked out what the electricity usage was passively. And when we came back, before we turned everything else on, we worked out what the electricity usage was when we turned everything on in the study. And that gave us a reasonable percentage. So legislation is not prescriptive on how to do it. It says as long as it's reasonable and if you can justify it when the auditors come and ask you some questions. Expenses incurred in earning exempt income or non-assessable non-exempt income. So for example, laundering your Army Reserve uniform. Laundry of uniforms would usually be deductible, but the income from the Defence Force Reserves are exempt, so any expenses related to it are exempt. We'll come back to these specifically excluded provisions. All right, so that's the basis of 8.1. Now, I want to have, before we go, probably not going to get to, not going to get to 26 about non-deductible stuff, but I will quickly whiz through 25. So, section 25. So 8.1 will allow us a deduction for most things. Include them in our bucket, take them out under the negative links. Section 25 deals with a whole bunch of expenses that 8.1 may or may not deal with very well. So it gives us some specific provisions which allows us to claim deductions. So section 25.5 allows us to claim a deduction for tax-related expenses. So if you pay H&R Irene from H&R Block, who loves nothing better than a complex capital gains tax question, if you pay them to do your tax return, $250, $200, you can claim that as a deduction against your assessable income. However, preparing your tax return is not incurred in relation to producing your assessable income. It is actually a byproduct of producing your assessable income. You don't need to do a tax return to earn your assessable income. You need to do your tax return because the government told you to. Yes? So 8.1 doesn't apply. But government recognises that they require you to do this, so they should allow you a deduction. So 25.5 allows you to claim a deduction for that. So costs of preparing tax returns, costs of objections, cost of dealing with the ATO in any kind of way, but it needs to be provided by a registered tax agent. Yeah? Okay, 25.10 allows us to claim a deduction for repairs, because 8.1 basically tells us anything capital in nature we can't claim. A repair to something that is capital would be capital in nature, and therefore we would generally not be able to claim it under 8.1. 25.10 says we can deduct expenditure that you incur for repairs to premises or part of premises or a depreciating asset used wholly or used solely to produce assessable income. So what constitutes a repair? It's a replacement or renewal of a worn out part, but not the replacement of the entirety. So if you repaint something, or you replace a belt on a washing machine, or you replace part of a fence, or part of a roof, or part of a motor, that's all repairs. Where you start replacing entireties or start creating improvements to something, substantial capital improvements to something, you move from it being a repair to being an improvement. And once it's an improvement, it's a capital item which you then have to subject to depreciation. The grey area in the middle where it moves is interesting and worthwhile if you've got a copy of the Master Tax Guide or the ATLS, having a look at the commentary in respect of what's a repair and what's not. There's some quite interesting cases in there that you kind of go, oh, I'm not sure how they work that out, but gives you some examples of what will be and what won't. Generally, a repair restores something to its original function and character, but doesn't substantially improve it or lengthen the life of it. Just some examples of repairs. So if you repaint a rental property after it's been rented out, because the last tenant's damaged it, that will be a repair. If you repair a stove in a restaurant, that will be a repair, but if you replace the entire amount, it won't be. Examples of capital. If you paint a rental property just after you purchase it, it isn't a repair. The reason why it isn't is because we refer to something called initial repairs. What happens with initial repairs is they're always capital in nature because the ATO consider that where you pay an expense for something and you incur it immediately after purchasing it, that your purchase price reflects the lower value because you recognise it was in a state of disrepair in the first place. So it really only forms part of the cost of acquisition. Okay? If you replace a wooden floor with a cement floor, that's given to be an improvement. Right. We'll finish off with the repairs because borrowing expense is the next topic. It actually requires a calculation in terms of working through it. So I'll get Colleen to cover that off next week. Like I said, in respect of repairs, just make sure that you have a look at the commentary in terms of when certain things have been considered to be the replacement of an entirety. So, for example, if you look at a car, some people would look at the car as the entirety. So if you replace that, that's when it would be more than a repair. However, there have been cases where you take out the engine block and put in a new one. That's considered to be more than a mere repair. That's actually an improvement to the asset itself. Okay, so in that case, it's not the car that's the entirety, it's actually the engine block that's considered to be the entirety, because you can actually pull things apart and they can be useful in their own right without being dependent on the stuff around them. So that's generally the positions the courts have taken. It's like when they're considering entirety, can you use something on it? Like, could you use something in something else without whatever's surrounding it now? Yes, you can't drive an engine on its own without something around it, but you can actually take it out of one car and put it in another. So it's basically a capsulized kind of asset in its own right. So there are some interesting cases in that commentary. All right, so next week I'll get Colleen to start off from borrowing expenses. If you can do a bit of pre-reading in terms of the rest of the deduction items, because there are some calculation ones in there. Borrowing expenses, self-education and prepayments are going to require some apportionment and calculation, so it's handy to have a background knowledge of how they work before you sort of sitting down and working through them. All right? All right. We will finish it there, and you can prepare yourself for stats, whoever's got stats. I'll have your tutor in here in a minute, kick him out. Thank you.
See ya.
I'm halfway across campus now.
I've seen those girls, like a lot of chicks are like tiny, like too short. Yeah, these should be like dolls, you know, like I stay here, you're like 4.9, 4.9.
Because we have like 4 regions, and different regions they have different policies. So people from different places, maybe the southern part of the region, possibly the other regions like some will look like
You are?
Africa.
What happened to yourself?
No, he listened to me after 6. Sorry.
Oh, you have class here? Oh, okay. All right. We'll see you. Oh, okay. Sorry.
Take your ass.
Okay, you too. Take care. Oh, you can sit there. Shan.
Richard,
Yes.
yeah, my last name is
What's your name? J. Just J.
Yes, Richard.
So you got this back as well. That we missed that.
Yes.
And what word is that?
How's the taxation?
Taxation.
What cause you?
So, I think it's, I really do CCA. It's right around years ago. You, how do you went to Jeddah?
Traveling from home to work private, traveling from home to work with the travel tools, probably deductible basically incurred in it depends. I mean, it's like traveling from home to work with the travel tools that aren't related to your work, then no.
Yeah.
So you just get your personal tools or something
Yeah.
in your car. But I guess what they meant by it's like a training, right?
Yeah, it makes sense.
Buying uniforms, sure. I've wrote that one as incurred in the earning.
Oh, okay, so you're saying, okay.
Yeah, I might be wrong there, but she did say that it's deductible when you're, for teachers, for example, who wear a uniform.
See, that's what I took was, I was like, uniform and shirt, is that like with an actual logo?
Yeah, like a
let's say
logo.
curtain or whatever?
Yeah.
That makes sense.
So I think
but
the
buying
distinction
shirts and
here,
stuff,
the
that should
distinction
be no
between a
deduction.
uniform shirt and just like whatever, say logo, just a button up.
Yeah. Should like, is there custom suit like a deductible?
No,
It would be, I don't think, because you could use it elsewhere,
exactly.
unless it actually says you had to pay for. No, man.
Unless it's
Yeah.
say you're a tailor.
This guy was like 160.
Well, that's a good question as well.
I
These
still
papers are not required, I guess, to wear it. It might be important to wear it.
See you guys.
They might get an allowance instead or something, I don't know.
Get an hour, you're just like, no.
Yeah. I just don't want to go to work. That's what's missing.
Yeah, I was still at another class. Because I was in a meeting. Sorry, too late. Yeah. A lot of work.
This one? Yeah, mine was like wrapped inside a cardboard box. Did you use it?
Yeah. No, it's like, it's out there.
It's getting rain on.
I don't think it might.
Has it arrived? Yeah.
I've heard it. No, it's coming today.
Is there anyone at your place? I might take it to the post office unless you elected otherwise.
I did say to you.
Oh, did you know? Sometimes I can do that and they still take it out.
Yeah.
Goes to
But
the-
like,